As we explained earlier, the core requirement of the ATR-QM rule is that you as a creditor must make a reasonable determination of the consumer borrower's ability to repay. This, of course, is already at the heart of your business as a lender. There is no legal requirement or any supervisory expectation that you make any qualified mortgages at all. Writing a qualified mortgage is simply another way to demonstrate compliance with the basic ability to repay rule. A benefit you get from writing a QM is that it gives you a presumption of compliance. There are two kinds of presumptions. The safe harbor, or irrebuttable presumption, means that the lender is considered to have complied with the ability to repay requirement. That means, for instance, that in the event a consumer alleges that the creditor violated the ability to repay rule, a safe harbor QM is conclusively presumed, as a matter of law, to have been made in compliance with the rule. The rebuttable presumption QM is what it sounds like. While there is a presumption that the creditor complied with the ability to repay requirement, that presumption can be overcome. You may already be familiar with the rebuttable presumption. The prior higher-priced mortgage loan ability to repay rule offered creditors a way to create a rebuttable presumption, but there was no safe harbor prior to these new rules. What distinguishes a safe harbor QM from a rebuttable presumption QM? The answer is the APR on the loan. In all other respects, the two are the same. As we explained earlier, this is one of the areas where small creditors were given special consideration by the CFPB under the rule. For all covered transactions issued by small creditors, both first and junior lien loans, and for junior lien loans originated by any creditor, a safe harbor QM is one with an APR that is less than 3.5% above the average prime offer rate, or APOR. First lien loans originated by creditors other than small creditors have a lower safe harbor QM threshold. They are safe harbor QMs if the APR is less than 1.5% above APOR. First lien loans originated by small creditors and any subordinate lien loan with an APR of 3.5% or more above APOR are rebuttable presumption QMs. First lien QMs originated by creditors other than small creditors have a rebuttable presumption if the APR is 1.5% or more above APOR. The method of calculating that APR threshold is another piece of the new rule that should be familiar to you. Prior to the January 2014 rules, you were calculating the higher-priced mortgage loans for purposes of the earlier versions of the ability to repay rule and mandatory escrow rules by adding 1.5% to APOR. You'll notice we said that QMs made by small creditors have a higher safe harbor threshold than other first lien QMs. What do we mean by small creditor?
To qualify as a small creditor, you must meet both an asset test and an originations test. Most FDIC supervised institutions meet these two tests, so the special small creditor QMs may be an important option for many of you. For 2016, the asset test threshold is $2.052 billion in assets as of December 31st, 2015. The threshold will be adjusted each year, so be sure to check the CFPB's website for the applicable asset threshold. In September 2015, the CFPB amended the definition of small creditor. The 2015 amendment did not affect the dollar amount of the asset threshold, but beginning in 2016, the combined assets of the creditor and its mortgage affiliates are considered, not just the creditor's assets. For purposes of this asset test, mortgage affiliates are those that regularly extend covered transactions secured by first liens, and the commentary explains that regularly extends means making more than 5 covered transactions in a calendar year. Also, the amendment added a grace period to the look-back period for the asset test. For applications received before April 1st of any calendar year beginning in 2016, the creditor may look to December 31st of either of the 2 preceding calendar years. The September 2015 amendment also affected the originations test. Beginning in 2016, the creditor and its affiliates must have extended no more than 2,000 covered transactions secured by first liens in the preceding year. Furthermore, the new 2,000 limit counts only loans transferred to another person. That is, the 2,000 limit does not include loans that are held in portfolio by the creditor and its affiliates. In other words, a bank that meets the asset test may hold an unlimited number of mortgage loans in its portfolio, up to the asset threshold, without putting its designation as a small creditor at risk. As with the asset test, a creditor can look back to its originations in either of the 2 preceding calendar years for applications received before April 1st of any year.
For the next segment of this video, segment 5, we'll discuss using qualified mortgages to comply with the ATR rule.